Hi everybody, hopefully you can see my screen and hopefully you can hear me as well. Apologies in advance, I do have a man flu. It's not man flu, I've just got a cold and a cough. So if I sound like a drain, apologies, and if I cough, I'll try and switch myself off before I do it. So don't go away if you hear a break all of a sudden. It's only me coughing in the background. As Anna said, I really wanted to focus on the pound because it has classic trading lessons. I'm not saying it's easy, but it's something that you have to be aware of. If you're aware of it, then you can take advantage of it. And it's all to do with market headlines. Now, before I go any further, I'm conscious there are a lot of new people in the room. So let me just explain what you're looking at here. We're on TradingView. I've got 6 pound charts up and they're all on the daily time frame, and I've got volume, and that's really all I have on here at the moment. I just wanted to keep it very clean. Down at the bottom here, we're on a live account. It's FXCM Live. I know a lot of you are aware of this, but basically we started this little project, if you like, back in January, not this year, the year before. And we started with around about $800. And the objective was to double the account every year. And I think last year we got to something like 1,500 and something. And I said, okay, this year we're going to try and double the account. And we've already done that as of October. Now, the purpose of this is it's not about the money, because when you actually convert what we've done so far this year into pips, you're talking about thousands and thousands of pips. And what that does is it just confirms that you have a methodology which is consistent, is reliable, which you understand. And once you've proved a point at this level, then as we explain in the program, it's not about the money, it's about finding consistency, because if you can produce 30, 40, 50 pips a month regularly, then the only thing you have to do thereafter is simply crank up the money, because you've proved you have consistency, you've proved your methodology, you've proved whatever your approach may be, it doesn't matter. The approach that we use on this very, very simple little account, and let's face it, going from $800 to $3,000, you know, that's $2,500, a bit less than $2,500. It's not bad when you consider that all we're trading on here are single micro lots at 10 cents a pip. So it just reinforces the fact that in fact, you can make money with a very modest account, provided you are sensible, provided you don't over leverage, provided you run with stop losses and everything else. The philosophy that we use on this account is very, very straightforward. It's single micro lots, and generally we are trading a basket of currencies. So over the last few months, we've been trading dollar baskets very much on here. I think we were doing yen baskets last year, but you could do anything. You could do a euro basket, you could do a dollar basket, a yen basket, a Swiss franc basket, whatever you want. But the reason I put the pound up is because the pound, when we were away in Italy, the pound was in focus. Now, ironically, up until that point, we've been short cable quite heavily because of the strength of the dollar, which has been rampaging higher, as I'm sure you're aware. But then what happens is you get politics involved. And what I've pulled up here is one of the headlines. Now, obviously for us, we're very conscious of what's going on in the UK. You may not be familiar with this particular online paper, but the principle can be applied to pretty much any market, because once it appears in the mainstream news, once it appears in what we call the red top newspapers, but in other words, once a financial market appears in the regular press, either shouting the good news, or in this case, the cataclysmic news. So it's either going to be stellar, everything's wonderful, you should jump on this bandwagon, this market's going to the moon. We've seen it with gold, we've seen it with cryptos, you'll see it with stocks. On this occasion, it was the market is going to crash. You know, it's terrible news for the pound. The pound is collapsing. It's going to go to unity. It's going to go below unity. How far is the pound going to collapse, etc., etc., etc. The news is awful, and it's everywhere. You can't avoid it. It's in every single UK paper, all talking about the pound, how dreadful it is, dreadful for the economy, blah, 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 blah. As a trader, you have to put that news to one side and you have to do the opposite. Now, I'm not saying it's easy, but that is the fact, because what the news media gives the market makers is it's manna from heaven. If you were a market maker and you saw this coming out to help you in your goal of making as much money as quickly as possible, what could be better than your particular market or one particular market plastered across the mainline news? This market is going to collapse, it's terrible. And what this also attracts is all the Johnny-come-latelys to the market, all those people who've been watching the pound fall and fall and fall. You know, cable now 115, then it went 113, 110. Those traders who've lost out and just been waiting and waiting and waiting, when they see this news, they jump in. They're the Johnny-come-latelys, they're the last people to the party. And what happens is they get trapped, because it's a trapping mechanism. It's designed with one purpose in mind, to reverse the market. It's the precursor to climactic price action. These huge plunges, big moves at the top, big moves at the bottom, lots of volatility, lots of volume. It's the ideal opportunity. Sorry, Dan. Lots of pips. It's the ideal opportunity to rack the market around viciously. But you have to put all that news to one side and view the opposite side of it, which is it's time to buy, which is what we did. And we bought big, because 99.9% certainty tells you that this market is going to reverse. Now, what you don't know is how far it's going to reverse. All you know is that it is going to reverse, because you cannot have that level of volatility, those volumes coming into the market. And of course, it's all associated with the price action as well. Now, as I say, it's not easy. You have to set all this noise to one side. It's a distraction, and you have to do what you believe is the right course of action, which is to do the precise opposite to what the media is telling. And I can't remember who said it. One trader said it, a very famous trader. He said, basically, you've got to buy when others are fearful, and you've got to sell when everyone is buying and everyone's complacent. And it is very true, but it's not easy to do. So basically, I've got the complex here that we were buying on. So you can really look at any of these. And when you look at, so let me just pop these up full size to make it a little bit easier on the eye. This is cable. This was the day we had all the plunge, all the racking about and all the rest of it. And you think, great, okay, you know, we touched, I think it was 1.03 something or the other, and we started to recover. And at that point you think, yeah, fine, time to get in. So you get in. We had a pause point the next day. Then we start to see the market rally. It's what you expect to see. The next question then is, well, how far am I going to ride this rally? How far is it going to go? How far is it going to take me? Do I add further to my positions, etc.? All those sorts of questions. Now, when you look at the following day, which actually set the alarm bells ringing, and you think, well, why has it set the alarm bells ringing? You've got tons of volume coming in. But when you actually look at this particular candle, and this was actually reflected across all the currency pairs within the matrix, you had extreme volume, but the price action doesn't match up with it. And this is just a classic example of what you have to look for with volume price analysis. It's all about whether price and volume are in alignment. In other words, are they in agreement? Does the volume actually make sense with the spread of the candle, or is it in disagreement? Now, it can be in disagreement because there's too little volume, or it can be in disagreement because there's too much volume. And when you look at this candle in the context of this volume, even just common sense would say, well, why is it that we've got a relatively small spread of price action? We've got a huge amount of volume. And when you look at it over here, you're always looking for sort of benchmark candles to try and get a fix on it. You might say, well, this could be our benchmark candle. It's not quite the same spread, but the volume is that much lower. So this kind of stands out. It's an anomaly, if you like. It's not what we would expect to see. For that sort of width of candle, given what went on over the last couple of days, I would have expected it to be, I don't know, somewhere about here maybe, you know, a little bit higher than the previous day, but not right up here. So what does that tell you? Well, it tells you that potentially this move may be running out of steam. It's not going to run out of steam just yet. So you see this on the day and you think, am I going to keep the positions open? Yep, I'm not going to close them out just yet. The following day kind of confirmed that we had what we were expecting to see. So this makes you a little bit nervous because you've got a doji candle following on decent volume. You still hold the positions. We were still holding them. The following day comes in, the market goes up again. You think, great, okay, not so bad. But what you've now got is a classic example in volume price analysis of a rising price and falling volume. This is not what you want to see. You do not want to see a market rising or falling volume because it's a sign of, it's not a sign of a reversal, but it's certainly a sign that the market is weak. In other words, it's going to come to a pause point. It may not reverse, it may go into congestion and may ultimately pick up again. So you don't read this as, oh, the volume's falling away, it's going to reverse, it's going to come all the way back down again. It's simply telling you that the market at this point is running out of momentum, the volume is falling away, the market is still rising. So at best, we're going to see a congestion phase build, which is actually what we said in the VPA traders chat room. We said we're actually closing out all our positions on pound at the moment. Just somewhere in here, I think we closed them out yesterday morning, I think, or even the morning before. I can't remember now. Or at Wednesday, yeah, I think it might have been the day before, or the morning, probably the morning in here, I think. We closed them out. We said this is coming to a pause point. It did actually carry on for a little bit that day, and now we're starting to see that pause point develop. And all of that whole rationale of how long to stay in this position was really dictated to us by this anomalous candle here on huge volume. Now, had this been over here, happy days. You know, we've got more volume coming in here. This is going to go even further. The fact it came in here on the rally is worrying, and that's the red flag that came up, if you like, and really hinted at the fact that we were going to have to be careful and not just, you know, let these positions run for days and weeks. We're going to have to monitor them quite regularly, even though we're spreading these over 3, 4, 5 day, 6-day periods. So that was on pounds. Now let's just drop that back down again. Yeah, now it also came up to a resistance level, which I've got on another chart, but I just want to talk about what happened on the other charts, because obviously you're not looking at one chart in isolation. What you're looking at is really, is this being reflected universally? In other words, is the pound being bought universally across the piece? And it was pretty much the case. And the charts were pretty much all the same. You had the plunge here, and off we go. There we had the big volume anomaly in here, exactly the same. Same again here, we had the plunge, then we've got the anomaly candle here, and now we're moving into congestion. Exactly the same here, anomaly candle here, too much volume, you know, not enough price action to match it, and now we're going into congestion. Right through to pound Aussie dollar. But the interesting one for us also, when you're doing these, setting up these positions, is when you look at the inverse. And I've mentioned this many, many times before in these webinars and elsewhere. If you're trading euro dollar, you know, look at the dollar Swiss, because it gives you that mirror image. It gives you the upside down view from a volume perspective, and also from a price perspective, and from all the indicators perspective as well. So you get this lovely, completely inverse view of everything, and it just gives you that much more confidence. Now, you know, we were watching this as the price action developed and then piled in all the orders on not only this platform, which to say was on micro lots, but also on our bigger accounts where we're, you know, trading big size. And this really gave even more confidence. We had this huge mother and father of a telegraph pole at the top here, and lots of volume going in there. It just looked really, really nice. So what is there to be frightened of? This is not, worst case is this is going to go sideways, and we were fortunate and just delivered straight away and off down the other side with a really nice price waterfall. But in the price waterfall, you've then got the mirror image opposite occurring. You've got a downspread candle here, but you've got a ton of volume under it. Now, why is that candle not twice or 3 times the size? It should be much bigger. It's not. So clearly there's something going on. There must be some buying going on in here, because otherwise, if this were a true representation, all things being equal, the spread of this candle, as I say, should be probably double that. It should be a nice widespread candle, and it isn't. It's compressed. So there must be some buying going on in there. And in the same way that when you're looking at a price going higher on falling volume, that's not a good sign. Well, neither is the opposite of that. In other words, a price waterfall on falling volume. So you've now got the opposite occurring, but it's confirming to you that it's exactly the same situation, because when a market falls, it needs volume. It needs volume to go up. We're all familiar with gravity and requiring effort to get something off the ground. But the same is true in VPA when a market is falling. It still needs effort. And if it hasn't got that effort, it's not going to go very far. So if you see a price waterfall like this developing and the volume is falling away, you know full well it's not going to go very far. Now, ultimately, at some point, this may pick up again, and obviously it will affect the inverse that's going on over on the pound-related pound counter-currency pairs. What we see here, we've got a pause point. What are we seeing today? We've seen an effort to rally. Volume is fine. It's trying to rally. It doesn't look terribly strong. It looks as though weakness could redevelop. And if we were going to jump back in other words, start buying the pound again, then you want to see this one go below this level. And then we'd obviously bring in lots of other indicators like the accumulation distribution. Now I've got that set up on, I think I took one of the charts here, if I can find it quickly. Here we go. Right, this is, let's move that down a bit. This is on pound CAD. We're still on the daily time frame. And you can see exactly the same. We have this big plunge, anomalous candle here, although not quite so anomalous, but nevertheless too much volume in here. Then what you're looking at is your other indicators. This is the accumulation distribution indicator. I kept it off all the other charts just for simplicity. And what the accumulation distribution indicator does is it's absolutely glorious because it's so simple. A child of 5 could follow this. You just look at the numbers. The numbers tell you the strength of each particular level. Plus, obviously, they are presented wider as well. So this has been tested twice and it's fairly narrow. This has been tested 5 times. This has been tested 6 times. So you know for a fact that when the price gets up to one of these levels, either from below or above, chances are at the very least, it's going to at least require some effort to move through. It may not bounce off it as it's doing here at the moment, really struggling to get through there in terms of resistance, but it will require some effort to penetrate that and to break through to the other side. So you start to bring all this together. And in addition to that, that's the dollar complex. In addition to that, you then start to look at the currency strength indicator. You're looking at that for perspective. You're looking at for entries. Now, you might be trading this intraday, in which case, I'm sure many of you know, I love trading reversals. So I'm always looking at the tops and bottoms. I'm looking for strongly overbought, strongly oversold. I'm looking for those reversals because I'm looking to get in early. I don't particularly want to jump on a trend that's already underway because I'm a greedy what's it and I want to get in early. And when I get in early, I'm quite happy to set a much wider stop loss because you have to allow for the buffering that goes on around these overbought and oversold points. But this was on the daily, and basically what we saw was this recovery in the pound, which was the yellow one. So it was already heavily oversold anyway, and therefore due for some sort of reversal on the daily time frame. And we've now seen that. We've seen that for several days, and it's now starting to flatten off a bit. Now, there is nothing to say that it may flatten off, it may reverse a little bit, but it could go all the way back up to the top here. Equally, when we go to the weekly, very heavily oversold and just starting to reverse up here on the weekly, and right over onto the monthly, you know, it really hasn't flattened off yet, but it's been heavily oversold on the monthly time frame as well. So you're looking at the currency strength indicator for confirmation. So we had the pound very heavily oversold. We had the dollar, the red line, very heavily overbought up the top there. So, you know, that all looked pretty good. And the reason that we saw such strong moves in most of the pound pairs was over that 5-6 day window, was particularly in the Swiss franc, because the Swiss franc absolutely collapsed and the pound Swiss was a huge mover. So that's the reason why, because you've got strength in one and equivalent weakness in the other pair. So that pair is going to move. And when you look at the currency strength indicator, that's what you're trying to identify. You want to see one that's moving sharply south and one that's moving sharply north, because that will give you the greatest trend. It has to, because you've got two components of the currency which are moving in opposite directions, so that will give you the greatest, strongest trend. We also had a trend in in the Aussie, because the Aussie was falling, so pound rising, Aussie falling. That worked well. We picked up a whole bunch of money on yen as well, because the pound was rising and the yen started falling off at the same time, kicked lower at the same time as pound started rising sharply. And we were making money in cable as well. Ironically, in euro pound, the euro is the orange line here and the pound's the yellow line. We still made decent money in euro pound, even though the two currencies were actually moving together. And as I've said many times before, you can make money. There will be a trend developing, but it won't be as strong as in other pairs. The trend in pound Swiss will be much stronger than the trend in euro pound, because these two are moving together with one another. Now, the reason you get a trend is because there is a differential momentum. So if the pound is being bought or sold more strongly than the euro, there will be a trend. It's just it's the analogy I've used many times before. I know you've probably heard it, is where you have two trains coming out of a station. If you're sitting on one train and another train pulls out alongside you, then maybe one of those trains will move faster, so the windows on one train will start moving away from you, or you'll start moving away from the other train. There is a differential speed there. So there's enough to create a difference. But when you've got two trains traveling in opposite directions, that is when you've got the greatest differential speed. And it's that kind of philosophy that you apply to all of this with regard to the currency strength indicator. And you can apply the same principles over here on the weekly and over on the monthly. So if I'm looking at that from a weekly perspective, I'm looking at this for long term. I may be looking at this on our little FXCM account and thinking, well, okay, you know, what am I going to get into next? I've got the Swiss franc up here heavily overbought, and the dollar's very overbought. Down the bottom here, pound, New Zealand, you know, any one of those combinations we could do something with. And equally, if that's confirmed over on the monthly, exactly the same scenario where we're looking at oppositions in terms of strength and weakness and support, oversold and overbought. Just to wrap up very quickly, because I'm conscious of the time, as I say, you can do the same thing. This is the dollar complex. Now, obviously, all of this is reflected in the currency matrix, because that's what the currency matrix does. It does it all for you automatically. But this is just the manual version. And all I've done on here is just to include some of the indicators on here. Again, just put the accumulation distribution. You put the pound cable over here, pull up full size. So when you're looking at this is the other aspect to it, right? What's happening today? Okay, we've seen the pound fall, but we're actually starting to see it recover now a little bit. So we've got a wick there. Be interesting to see what happens at the end of play today. Depending on how that pans out tomorrow, if we start to see, you know, a solid move higher, we might be inclined to jump back in again and start to build those positions again if the pound is going to be bought more strongly. The next question you've got to ask yourself is, well, how far is this likely to go on this particular time frame? Bear in mind, this is the daily. Well, purely looking at it from the prism of one indicator, the accumulation distribution indicator, it's fairly obvious where the next pause point might be. It's probably about here, which is at 121. So if you're riding this higher and you're jumping in, maybe you get in at 116, and this is only looking at it through one perspective, through the perspective of the accumulation distribution indicator. We could put the VPOC on here. We could look at the Camarilla levels. There'd be all sorts of other indicators we could look at, but just looking at it from the perspective of one indicator, we can say quite confidently that if we get in at 116, let's say after we've had a little bit of a rally breakthrough, then the chances are based purely on price, because the accumulation distribution indicator is purely based on price action and where the price is likely to pause and how many times it's hit and being resisted at all these levels. So when it gets to this level, the chances are it's at least going to struggle there. It's very unlikely that it'll just blast straight through there and carry on higher unless there's some major piece of news that drives it, and it will be supported with volume, obviously. But all things being equal, the chances are it's going to congest there. The same principles apply when you're looking at the VPOC. You know, if the price is approaching the VPOC, what's going to happen? It's not going to go through there very quickly. It's going to congest. It may well continue with the original trend, but do you want to sit through a whole phase of congestion? The short answer is probably not. So that's the pound. If you ever see any market appear in headline news media, and I'm not talking about financial news, I'm talking about the regular newspapers, the daily news sheets that come out with all the home news and everything else. If you ever see a market mentioned in there with either very good news or very bad news, do the exact opposite of what it's saying. Now, finally, just to wrap up, and I'll just pass back to Anna because I've gone way over time. I just wanted to show you this. I'm actually going to do a video on this. You won't have seen it before. This is the Renko indicator for TradingView. And it has two ways of using it. You can use it as a traditional Renko, or you can use it in this mode, which is called the time accurate Renko. And the reason it's called the time accurate Renko, and you won't find one anywhere else because no one else has developed one. The reason it's called the time accurate Renko is because the Renko bricks actually match to the price action. With a Renko, they do not, because a Renko is independent of time. So it's very difficult to match the Renko bricks to the actual physical time that they are being built. And that's why we developed this indicator, which is the time accurate version of the Renko. It's 2-in-1 indicators. You choose which one you want. Now, the unique aspect to it is not only is it a unique indicator, but also the fact that you can overlay it on the chart in this way. And I'll do a video to show you how to do that. So you can actually slide the price action around. You can have it wherever you want, and it just looks fantastic. And it's really a super indicator to help to keep you in a position. It's a bit like a trend monitor. It's a bit like a trends, because you don't get the noise associated that you do with a traditional Renko. You get these very solid bricks building. You can adjust them to any size you like. I've got this set to 3 pips. Just click on that and go into settings. That's where I've set it in there. And these are the two modes you've got. You've got the time accurate Renko, or you can set it on the standard, and it's both done through there. And obviously you can also set this to an ATR size where it'll do it automatically for you. But I like to actually select the brick size itself. But it just gives you this fantastic visual representation of a Renko, but a Renko with a difference. And it just builds these lovely bricks, the solid walls. When it goes into congestion, it goes into these modes. And if it's going to carry on higher, it'll come out the other side and start building again. It's just a really, really cool way of using it. And as I say, you can slide it around like this. And obviously at the bottom here, we've got volume as well. So we've got really everything we could want. We've got, in effect, a non-time-based indicator up here in the time accurate Renko. We've got a price chart, and we've got our volume at the bottom. And we've also got the accumulation distribution indicator on here as well, building as we speak. I'm going to stop there, and I will pass back to Anna, if I may. So, yeah. Sorry, I keep the chat box closed when I've got it, when I'm in full flow. Are all source providers on TradingView accurate for volume, or is there one that you prefer? I just use the volume that comes with TradingView. I have the that's the broker volume. I have the FXCM account attached. The nice thing with TradingView is if I pull this up, these are all the accounts that you can actually link direct to TradingView. They're always adding more. It's a very, very simple process. We have FXCM linked here, but I could link one of our interactive brokers accounts. I could link one of our TradeStation accounts. You know, it's very easy to do. I'm not, you know, making a pitch for accounts here because we're not allowed to, but it's just a really nice way to attach your account. And in addition to that, when you're trading through here, I'm just looking for, where's that gone? Oh, there. No. Disappeared. Where has it gone? Disappeared completely. How strange. Normally hovering over there. You can trade off the screen here. So once your account is connected, you just literally trade off there. It's very intuitive, very simple. Stop losses, one cancels the other. You've got all sorts of limit orders, market orders, whatever on there. It's all there. So I hope that answers that one. No, I just use the volume is fine, absolutely fine on TradingView that comes with it. Do you have a preference of which platform to use according to the instruments you're trading? That's an interesting question. It's more to do with it's more to do with the markets, David, to be honest. What we always say to all our students who come on the Forex program is, if you are a novice or relatively new, then start with the MT4 platform, or MT4 and MT5 are a single platform for us because you can switch between the two. There's no differentiation. You do it. You have a dashboard with all the indicators on, and you decide which one you want to use. You just flip between the two. It's a different download, but there's no extra charge. So you have MT4 or MT5. So that's what we always say for our new students in the Forex program, is start with MT4 and MT5. The reason for that is simply that it's very simple, it's very intuitive, and it's an all-in-one solution because everything comes bundled together. You've got live feed, you've got a platform, and you've got brokerage. So you don't have to worry about bolting everything together. Now with MT5, obviously, it does expand the market somewhat. So you do get access to synthetic indices, to synthetic stocks, and so on and so forth. So you can trade those markets as Anna does. She's on the indices quite happily, fine, absolutely no problem at all. You don't have to have a futures account, which is wonderful. So you're just trading the same markets. When you move to other platforms, you would generally, what we find is our students and customers we have like to then move to Ninjatrader, for example. Now, the reason for moving to Ninjatrader is it opens up other opportunities in two ways. First of all, it allows you to trade futures, true futures, and stocks, predominantly US stocks, but also it allows you to trade using tick charts because MT4 and MT5 do not support tick charts. They don't have the database of data. So once you move to a platform like Ninjatrader, you can then start to use tick charts, which again, like Renko, are a non-time-based approach. So what you see with either of those particular charting applications, you see momentum. What you never see on a time-based chart is market momentum, because a time-based chart will time out at the prerequisite time. So after 5 minutes on a 5-minute chart, the candle will build, bang, onto the next one. That's it. There's no ifs, buts, or maybes. That's what happens. If you're on a Renko or you're on a tick chart, the speed at which those candles will, or the time in which those candles will be built, will vary constantly, because what dictates the build of the brick or the candle is either the number of ticks you've set to the tick chart. So if you're on a 150 tick chart, then once 150 ticks have gone through, the candle will close, move on to the next one. It'll do that irrespective of whether that's happened in a microsecond, a nanosecond, 5 seconds, or 5 minutes. The same is true of a Renko. If you set your Renko brick to 3 pips, and 3 pips doesn't arrive for half a minute, then your Renko brick is going to build in half a minute. And that's what makes tying, as I said earlier, tying a Renko brick chart to a time chart and actually seeing and piecing it together and saying, well, that bit of price action's there and this brick movement was there, and I think that's right. That's what's so difficult about it, which is what's so different about the time accurate Renko, where it's actually matched brick to price. So Ninjatrader will offer those opportunities. The same is true of TradeStation. Now, TradeStation, if you like, goes a stage further because what TradeStation offers is an immensely powerful scanning option with the radar screen. With radar screen, you have a phenomenal power to search and sort on vast numbers of stocks by any number of combinations of things that you could imagine. It really is immensely powerful. So on TradeStation, again, obviously you can trade futures through TradeStation, but the difference with platforms like Ninjatrader, TradeStation is that you then have to move to a situation where you're bolting everything together. So with Ninjatrader, you've got to buy a live feed. We recommend Kinetic as a live data feed. It's fantastic. It has all the tick data and all the rest of it. And in addition to that, you've then got to find a broker. And if you want to trade through Ninjatrader, you've got to link your broker to Ninjatrader and so on and so forth. So you're basically dealing with 3 components that you've got to link together. Or you say, well, actually, I'm going to use this platform for analysis and I'm going to trade through that brokerage account. You may not have them linked. Some traders do and some traders don't because they can't. So it's horses for courses, and the same is true of TradeStation. You may decide that you'll have a TradeStation account and trade through TradeStation itself, or you may decide you don't want a TradeStation account and you want a separate brokerage account, but you want the TradeStation platform. So you have 2 separate elements. Equally with NinjaTrader, they have their own brokerage, so you could trade you can trade through NinjaTrader and their brokerage. They bought, can't remember who it was, about 5 years ago. They bought an account. They bought a broker, and that became the NinjaTrader brokerage. TradingView is probably the one that stands apart, primarily because it's a browser-based application. So as Anna said, we were in Italy and we could just trade. Now, that's not to say we can't trade with all the other platforms. We could have done, and we had the capability to do it as well. And we had those platforms up. We were running on Windows as well, obviously. But the beauty of TradingView is that you can trade anywhere with it on any platform. It's non-specific. So you can trade on Mac with it, you can trade on iOS with it. It's a purely freestanding, it doesn't require Windows, and it has all the goodies, got all our indicators on there, and indeed 1 or 2 more that aren't elsewhere. We've put the radar screen on here. We actually developed our own radar screen for TradingView as well. So it's really horses for courses. Now, it really depends, if you want to trade index futures and you want to trade the CMEs and all the rest of it, then you'd probably go for NinjaTrader or TradeStation. If you want to trade stocks through here, stocks on TradingView, fantastic. You've got much broader markets than you have on NinjaTrader. NinjaTrader tends to be very much US focused. TradingView is not so much that. You can trade pretty much any market around the world, and so you go on. So it's really just finding what suits you. We are always developing new platforms. The one thing I would say is that you can transfer your indicators from one platform to another at any time. There is no cost in doing that. Some companies charge, we don't. We never have done and never will. So if you start with one platform and want to transfer to another platform, perfectly fine with us. It's free to do at any time you wish. Can you use the new Renko for stocks or cryptos? You can use it for any chart you wish. It'll work. Yeah, I'm just going to transfer back to Anna.